Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Circulus will be hosting its next Family Office Summit on May 15th in New York for 75 family offices, and will feature Jim Tannenbaum, founder of Foresight Capital and a previous guest on this show, as well as Roger Ferguson, the former vice chairman of the Federal Reserve, in conversation with Rebecca Patterson, also a former guest of this show. If you are part of a single-family office, you can apply to attend at circulus.substack.com. Mark Strauch is a founding partner and president of the private equity firm Alpine Investors, known for its unique CEO training program. With a background in industrial engineering from Lehigh University and subsequent business studies focused on finance, his career spans operational roles at companies like Electronic Arts, entrepreneurial ventures such as the early cloud concept Desktop.com, and significant leadership challenges, including orchestrating a complex turnaround as CEO of Business Engine. Mark provides a detailed look into Alpine's operational methodology. He explains the origin and mechanics of the firm's fascinating CEO in residence and CEO in training programs, illustrating how this focus on securing leadership talent prior to acquisition shapes their investment strategy, sourcing advantage, and approach to scaling portfolio companies, exemplified through the creation of the company we'll talk about called Ascend. He also discusses the firm's distinct culture, its strategic focus on talent and add-on acquisitions, and offers his view on market dynamics, including exit strategies and the role of AI. Please enjoy my conversation with Mark Strauch.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
I think the easiest way to start always is just to give us a little bit about your background.
I grew up here in Walnut Creek, California, which is a suburb of San Francisco, the last of 4 kids. I was a mistake. I always tell people I'm just very happy to be here. Growing up, loved learning, especially anything that had to do with math and logic. Loved team sports, a lot of character formation for me in that part of my life. And then I'd say my upbringing was big emphasis on character and hard work and independent thought. It's probably a big part of it. I always feel like I was pretty blessed with loving, supportive parents, which I think is an unfair advantage. My mom was a classically trained musician and my dad was a fighter pilot. So that's a fascinating combination. They instilled in me, I think, the gift of self-belief, maybe even irrational self-belief. They believed in me and let me know it. And I've carried that gift forward, hopefully, to my kids. Career-wise, so I got a baseball scholarship to Lehigh University where I studied engineering. And at the time, they were called the Cleveland Indians. They were nice enough to inform me that I wasn't good enough to pursue a career in that field. And they were right. Most of my career has been in and around San Francisco and Silicon Valley. Never really chased brand names. I think for me, it was always solving for learning, maximizing your learning curve, and people, being around people I admired. And I always was looking for who will bet on me, maybe before I'm even ready. So I started out in consulting, which at the time was what you did when you didn't know what you wanted to do. And I knew I didn't want to be a consultant, but I had a lot to learn. So I enjoyed that. One of my clients was Electronic Arts. I ended up going to work with them, which was one of these moments where I was put in a director level job at the ripe old age of 24 and way over my head. And that was perfect. It's exactly what I wanted. I ended up going to business school. I think the main idea there was to learn more about finance and business.
But you had studied industrial engineering, right?
Because it was hard and I wanted to do something hard and I didn't know if I was going to directly use it, but I wanted to learn how to learn. And I think the idea that I had going in was I want to be able to go into any situation and take some hard problem that I didn't know the answer to and somehow have the confidence to break it down into smaller problems that maybe I did know the answer to. And that was a logic exercise for me that engineering was well suited to.
Do you think of yourself as an investment guy or as a business guy?
Yeah, I've been asked that question before. I think probably more as a business builder is the through line, Joe. I love the investing intellectual stimulation. I love the complexity of it. But I also love the carbon-based organic leadership of people and strategy and vision and things of that nature. So those two worlds collide beautifully at Alpine, the way we built the firm. So I'd say business building is probably the through line.
But what did you learn in business school that shaped your future? Obviously, you didn't go into engineering.
I think I learned about how to just think about businesses differently. Having started in more of an operational realm prior to business school, I wanted to attack the value creation from the top down. And being in Silicon Valley in the early 90s, there was just an explosion of innovation. This was the beginning of the commercial software industry. And then years later, the beginning of the internet as a commercial platform. And just being able to understand, just using numbers, how to create value. The analogy is, as a pilot, if you are flying by instruments only, if you could just describe a business or a market using numbers, which would you pick? And I just wanted to add that sort of heavier quantitative, more top-down financial perspective to what had prior been a bottom-up operational view.
Are you a fan of John Boyd?
Oh, my goodness. Yes. Boyd, it's funny. I think of him as Jack Boyd, and maybe that's why I didn't trigger, but the OODA loop is something that I've heard come up a few times recently. I brought it up about 10 years ago, and someone said, "What are you talking about?" But I am very familiar with the observe, orient, decide, act framework, and I love it. I still use it today.
Do you think an early interest in baseball is a good indicator in an investor?
I think team sports, but whether it's baseball or not, is not typically associated with investing. And I think I saw that as maybe an opportunity to do a different kind of investing firm, because certainly there's a very quantitative, geeky aspect as to Moneyball and baseball statistics and things of that nature, which I'm interested in. But I think to me, it was more the counter thesis of how the application of a very singular, financially minded investor could add the dimension of how to build high performance teams, which came from team sports. And what if you build a firm that was founded on that philosophy? And what if not just the firm was founded on that philosophy, but what if that was a central tenet of how you would build businesses in general? And so I think it was maybe the fact that it was not conventional to think that way that I was drawn to.
1998, you were part of a company that was on the front page of the Journal. You were going to do cloud computing before there was cloud computing. Tell us about that.
I haven't been asked that question in years, Joe. I of course you would go there. I love it. The company was called Desktop.com, and it was a Sequoia XL KKR high flyer. It didn't work. But the idea was so beautiful that it came true, 15 years later? The idea was to be the Microsoft killer. And that someday, now that we had this commercial internet, all of your files and apps and things would be in the cloud. Of course, we didn't have the word cloud then, which would have been nice. But the idea was that bandwidth would allow all of that to be on the server side. And so the company was this beautiful concept of building a consumer-facing drag and drop interface rendered in the browser and a developer-facing platform to write to this new platform. And it, long story short, was a beautiful exercise in learning and ultimate failure, but really kindled my interest in entrepreneurship. And that's a lot of kind of a way we think about Alpine is entrepreneurship through acquisition.
Now, was that more of a business problem, or was it just infrastructure and the pipes at the time?
I think it was a technical problem. I think the model and the concept, of course, was beautiful. I think the bandwidth didn't support at the time the heavy computing cycles required to pull it off. We're trying to take advantage of computing cycles on the client to render this sort of rich Windows-like interface at the time, and it just was too slow. And so that really limited our ability to have parity with what personal computing was able to deliver at the time with Windows. So I think it was a lot to do just with we were too early. The infrastructure wasn't there to pull it off.
What did you do right after that?
I was recruited to a company called Business Engine, which was a venture-backed enterprise software company. The company was backed by Oak, TCV, and Morgan Stanley venture partners. I may have joined in 2000. I forget whether it was because I remember living through the 2001 collapse at the company. It was a software for large IT shops, Wall Street banks, big pharmaceutical companies that spent billions of dollars in IT. That story, I ended up becoming the CEO in a turnaround of that business, which was like 10 years of experience crammed into 2.5 years.
What had happened before you came there? There was some issues, right?
Yeah, a calamity of errors and a little bit of tragedy along the way. But I think the story there was the business was growing, was probably 250 employees. We had raised a Series D financing. The prospects were quite bright. And then the market collapse happened in '01. And then one day I show up to work and there was an FBI raid of the offices. And that was startling and just crazy. What is happening? People were turning to me and saying, what do we do? And I said, cooperate. I don't know what this is. And it turns out that one of the individuals that was on our executive team had basically been found guilty of stealing trade secrets from a direct competitor. And that was something that no one knew about and we got to the bottom of, and it was a huge setback for the business, reputationally, paying a penalty. And it just is one of the things that's very hard to recover from. So in the aftermath of that, the company struggled and the board came to me and said, would you consider becoming the CEO of the business and turning this thing around? And we did. The turnaround worked.
That sounds like a real catastrophe. What was it about that situation that caused you to stay?
The product, the value proposition, the customers, they all mattered. It all worked. But the externality of that event was just a huge headwind. And so there still was a kernel of goodness there that could be built on. And there was a lot of people that had worked hard to build this company. And for me, as someone who aspired to become a CEO, it wasn't exactly how I drew it up, but it was an opportunity that I felt was a time to meet the moment. I remember the quote from Ed Glassmeyer, who was really one of the famous founders of venture capital at Oak, turned to me and gave me the inspiring speech of, sometimes, Mark, it's not about who's right for the job, it's about who's left. And so that was something I never forgot. And there was a book called Accidental CEO that was written loosely based on my experience at that company, written by the executive coach who was sent to work with me at that time. His name was Tom Vacola. And I politely declined his services when he showed up in my office, only to learn that it was not an offer, it was an assignment from the board, having not been a CEO before. So he ended up being instrumental for me as a leader. And in fact, so instrumental that later when we get to the Alpine part of the story, we ended up basing our entire strategy and culture playbook on his intellectual property, which we acquired. And we gave him a Lifetime Achievement Award for all his work he did with Alpine. So I ended up partnering with him for many years.
How did you turn it around? And what was the outcome?
The outcome was quite good on the turnaround. We had to recapitalize the business, of course, which washed out some of the early investors. And then the new recap investors did quite well. We ended up selling the business in 2007 to a company called PlanView. And it was, I think, in the estimation of the board, quite heroic to have done that. It was certainly not life-changing wealth by any means, but it proved to me that I had what it took to lead. The main thing was really just getting back to basics on making sure we put our arms around our existing customers and explain to them where we were headed with our product roadmap. We were very transparent. We formed an advisory board and brought them all in and said, here's where we're going and we need you to work with us. And here's why this can be a good thing for you. They embraced that. And I'm very grateful for that. Some of the larger Wall Street banks kept buying more and more from us. And we rallied the troops. We looked each other in the eye and said, hey, we can do this. And this is not what any of us expected, but this could be our finest hour, so to speak. And like I said, I look back very fondly on that experience. Sometimes your greatest victories aren't necessarily the ones with the most zeros behind it, but it was massively gratifying to turn that business around.
How did you meet your partners and what is the origin story of Alpine?
Yeah, I mean, if you fast forward that story a little bit, I went to business school with one of the early partners at Alpine. His name was Will Adams. And I remember They were forming what would become the early days of Alpine in Fund One. Then they were talking to me about whether I would come and run one of their businesses. And I said no several times because I was in the venture backed world and really had done exclusively software at that point, and this business was a tech-enabled service. But I ended up capitulating, and I ran a company called EDC, which was an early investment in that business. We built a remarkable team and were able to grow, really tripled the core business in about 2.5 years and had a very nice exit. And at the end of that sort of rapid experience, we sat down, myself and Graham Weaver, Dan Sanner, Billy McGuy, who were my co-founding partners. They had stood up Alpine and they said, we have two choices here. One is we could back you again to run another company that we invest in, or what if you joined as a founding partner at Alpine and we used you as patient zero for this CEO in residence model where we took the playbook that you did at EDC and rinsed and repeated it across all of our investments systematically. It turns out to be a wonderful invitation to have a new challenge, to be an investor business builder rather than an operator business builder. And I really love those guys. They are very close friends of mine, and we work together for now, 15 plus years. And I was drawn to the idea of business building through the private equity lens, but doing so with a culture that wasn't the prevailing Wall Street culture. And that's really what I think Graham Weaver in particular, as the original founder, deserves so much credit for, is building the kind of firm that we would want to work in. So I joined the firm at that point and took it from what was a $50 million Fund One to now nearly a $5 billion fund. And it's just been an honor to be on that journey.
What was the prevailing Wall Street culture?
Well, a few of us had worked in banking and it was just transactional. And it felt like you would be using maybe 10% of your brain. You'd be working a lot of hours, but it's very hierarchical, not entrepreneurial. As young people, you stay in your lane and you perform tasks and your life is miserable. I'm exaggerating. Obviously, I don't mean to offend anyone, but that's basically what that looks like. And we have taken the opposite view with Alpine. We work very hard and spend a lot of hours building this firm, but it's highly empowered and I would say entrepreneurial. And so to me and to Graham and to the other partners, it doesn't have to be that way. In fact, not only does it not have to be that way, but it's what could we unlock if we built a different kind of firm that didn't look like the other firms?
What was it like raising that first fund?
I wasn't there for the first fund, but that would have been in 2001 is when the firm was originally founded. And it was a $54 million fund and it did not go well. It was the opposite strategy of what we do today. We've sometimes gone so far as to call it a bit of a face plan, but we were buying the cheapest businesses we could find. We were inheriting managers and we didn't really have religion as we do now on the power of leadership talent, world-class leadership talent. So there was a lot of diving saves and inserting of ourselves into the firms to try to salvage one time's return of capital. Mercifully, our very gracious and loyal early investors could see that there was something to believe in there. And again, I think Graham and Billy and Danny deserve enormous credit for that. And so by the time I joined the firm, we were a little bit more on our way. And then the pivotal moment in the firm, which we can talk about because I think it's instructive to where we are today, is when Lehman collapsed in 2008. That's really where we went 5 years in between fundraisers and the market was, of course, very brutal. And we turned our focus on ourselves and we asked a really important question, which would guide the rest of our history to this day, which was what would it look like to be the best performing private equity firm in the world? We probably had no business asking that question at the time, Joe. The audacity of it is embarrassing to admit almost, but that we gave ourselves permission to imagine. And I think at that time, we made a decision to be different and we set a big, hairy, audacious goal, which we call our North Star. And it was 3 parts and it still guides everything we do to this day. The first is let's be the best place to work for exceptional people to spend their careers. The second was let's endeavor to be the #1 performing private equity firm in the world as measured by something we call 3x net. We don't care about asset accumulation. We only care about performance. And so let's endeavor to return at least 3 times the fund, net of fees and expenses, every fund, every time. And to our knowledge, no one has ever done that. Many firms never even get to 3x even one time. And so that was the yardstick for us for being the number one performing firm. And then the third part of the North Star was to be a force for social good. That inspires every single one of us at Alpine every day to chase that North Star. And it resulted in a very different kind of firm on strategy, very different strategy, and on culture.
Tell me a little bit about your process. What kind of companies do you guys like? What's your sweet spot?
Well, maybe the best way to answer that, there's a lot of layers to that question, Joe, but I think is just what is the core strategy at Alpine? And it's based on leadership talent. We call that people first. And the core premise at Alpine in terms of how we invest is that great investment outcomes in the middle market come, in our view, from backing exceptional leaders. So hire, develop, and unleash great leaders. And in a private equity world where I'd say 98 to 99% of private equity firms back continuing management, we do the opposite. So we seek deals where we can bring in our own leadership team, and to such a degree that we hire the CEOs first, and then we go find the businesses, the investments that they will run second. So playing a very different game, and we've seen firsthand the returns, the result from that model. So 75% of our deals are proprietary because we're basically fishing in a different pond, if you will. We've built up enormous scaffolding and infrastructure and talent. We have 15 people in talent at Alpine, 25 executive coaches that are trained in our playbook and work with our leaders. And then we've launched 2 core talent programs, many more than that, but the 2 most instrumental are the CEO in Residence program and the CEO in Training program. So we now have 114 CEOs in training, and other CXOs that have come from these programs that are currently active in our portfolio. And our CEO in Training program in particular has become the number one most applied to business school job at Harvard, Stanford, Wharton, and Kellogg, which I still, when I say that, it boggles my mind because we never imagined it would be that big. So that's the core strategy. We invest in software and services businesses. We have about $17 billion of assets under management. These are recurring revenue, recession-resistant, asset-light, mission-critical businesses. And we tend to do control investments where, as I say, we can put in our own talent, and then we like to do a lot of add-ons as well.
You're saying that you're plugging in the talent that you have, but I'm curious what the screening process is like for the companies. Obviously, you're always out there looking for opportunities. Is there anything in particular? I'm sure you guys know the ecosystem so well that you can see a company, you can immediately start thinking about add-ons and where it would fit in, and then bring in the leadership piece, or am I getting it backwards?
No, the 2 decisions that we make up front are industry and leader. And sometimes the leader is first, sometimes the industry is first, but in all cases, both of those 2 things precede the actual deal. So in terms of industry screens, we have stood up a new market review function that we're endeavoring to try to be best in the world at how we do trend spotting, how we do use the experience of our past and the successful bright spots to inform a scorecard for industries. We do quite a bit of upfront work on those criteria I just mentioned. We want there to be, ideally, if we're pursuing a buy and build, we want it to be highly fragmented. We want the recurring revenue quality to be very high. We tend to prefer asset-light businesses that don't have a lot of capital expenditures. We're looking for opportunities, as I said before, that for whatever reason it may not present with ongoing management. What that means is a lot of times we're looking at founder-led businesses. In terms of the leaders, there's an equally rigorous screen on the types of leaders that we look for. We're believers, as everyone is, in experience, but I think one of the things where we differ is we have gone to great lengths to measure attributes, personal characteristics, things that sometimes are difficult to assess. The grit, for example, or emotional intelligence, or will to win, or humility of a leader is absolutely predictive in our view of their ultimate success. And so we are big followers of the top grading process, where you endeavor to use data to measure those attributes, and they're very correlated with our best CEOs. So there's a screening on industry, there's a screening on leader, and then of course we have a huge emphasis on direct sourcing. So we're doing a lot of talking to companies and outreach with a pretty large dedicated team of origination people.
You invested in this interesting company called Ascend. How did you find them, and who was the owner?
That's the interesting part of Ascend is it's actually a new co that we created. So the industry is outsourced accounting services. If you think about the outsourced accounting market for small and medium-sized businesses and high net worth individuals, it's a $58 billion market. It's growing at about 7% a year. And we became intrigued by this market several years ago with an inbound deal. The deal itself wasn't right for us, but it really got us thinking about accounting as an industry. And we started doing a lot of work, really a full year, maybe a year and a half prior to forming Ascend. And we really liked what we saw. There's 95+% net revenue retention because it's a highly recurring, very sticky customer relationship. It's certainly mission critical. And there was an opportunity that we saw to win through talent, which of course is a big part of what we like to do at Alpine. And the reason is that accounting is a talent constrained industry today. The demand for qualified accounting talent really exceeds supply. And if you think about the typical independent accounting firm, they're facing some very real shifts at the moment. Three in particular, one is talent. Fewer CPAs entering public accounting than are leaving. And it's also expanding now to a global workforce, and offshoring is a very challenging thing for these regional firms to get their arms around. So talent is a huge lever here. Technology is the second one. As you might imagine, there's a growing impact of technology to deliver better client service, and AI in particular as an imperative. And then third is the economic and governance piece in accounting. There is a legacy partnership model, which can sometimes impede decision-making and can sub-optimize economics for the up-and-comers. So we looked at those things and really fell in love with the opportunity in this industry to make a difference. And in particular, the fragmentation outside of the top 100 firms, say, Joe. So it started with the industry. And then, as I mentioned earlier, then it's the CEO and the team. And so before we even got started with deal making, it always starts with finding the right CEO. That's what People First is all about. And David Wurzbacher, who was a repeat Alpine leader for us, we brought into residence, and he started working alongside us on the accounting thesis. He had run a buy and build for us in the past. He also, Joe, graduated years ago or years prior from our CEO and training program I mentioned, which is a theme for us. And just an exceptional leader, deal-making savvy and also operational chops. So we hired David, brought him into residence, and then we brought two other people into residence, an experienced private equity deal maker named Nish Ruparel as president.
When you say in residence, what does that actually mean?
It means we hire them and they join our deal teams in the office. And so we're paying them full salary, and we are working with them to go find the business that they're going to run. So the term People First quite literally means we start with the leaders first, and then we find the business second. And it's a radically different model, which has made kind of all the difference for us. Anyway, we had David, we had Nish as the president and head of M&A, and then we had a woman by the name of Erin Stammer as our chief people officer. So we had the industry, and then we had this sort of in-residence team that we were excited about. And we spent months at that point developing the playbook for how we were going to win in accounting, everything from organic growth to the M&A scorecard to mapping out how we would organize ourselves into a national accounting firm with a terrific culture. And so all of that, I still haven't answered your question, speaks to our model. So all of this fuss about the industry and the team and now it's time to say, now what about the deal? And as a traditional private equity model would be to start by finding a larger platform business at the beginning, and then to do more tuck-ins after that. And our model is different, but very similar to 8 or 9 other aggregators in various services industries we've done, like HVAC and plumbing and roofing and facilities maintenance, and home restoration, et cetera. And our model is basically to create a new co-holding company and think of that team of people as the platform. It's this entrepreneurship through acquisition kind of model where that holding company has the executive leadership, the embedded M&A team, the playbook, some subject matter experts around growth, and then a backbone of shared services around talent and technology. So in our parlance here, the platform is this new company we've created called Ascend. And the whole idea there, Joe, that I just want to make sure I emphasize is when you're doing a buy and build like we're doing in accounting, and I can give you some of the statistics in a moment because it's been about 1.5 years, coming up on 2 years since we started Ascend. You see a lot of firms do what's called roll-ups, right? And it's basically financial engineering for the benefit of investors. And our view was, what if you could take the buy and build model, but orient it around the benefit of the accountants and their clients to create an altogether different and better proposition for the industry, rather than just a financial engineering construct. And so we formed Ascend in January of 2023. Our first deal was a firm in New York called LMC. And so we've owned that business for about a year and a half. That firm has already doubled in size. Since then, we've partnered with 23 different firms. So been very acquisitive. These firms are growing at 15 to 20%. Ascend now has 1,300 employees. We've got 54 people at the sort of holding company level, and 9 of those people have come from the Alpine talent programs that I talked about. And I think the reason this different model, if I could just go one step further, Joe, is so important to us is that the private equity experience in the accounting industry hasn't always been positive. So our idea with a different model is, let's build Ascend to meet what we view as the 4 main things that these accounting firms who are already successful, what do they want and need? And the first thing these firms want is independence. So we maintain the partner firm legacy and identity. So it's not the end where they get assimilated into the Borg, so to speak. It's the beginning of what's next. So they maintain their independence is thing one. Thing two is they want resources that can help. As I mentioned, a lot of challenges. And so Ascend is providing the critical business transformation resources and growth and talent and tech and offshoring and so on. So they want resources. The third thing these firms want is economics and liquidity. And so our role as Ascend is to introduce a modern financial model that provides the right incentives for the senior partners, the junior partners, the next generation, because that needed a little bit of re-engineering. And then the last thing they want is, frankly, a partner they can trust, that where you can have long-term runway with a people-first type of culture that people actually want to be a part of. So I think Ascend's an interesting example. There's certainly been plenty of learnings along the way, but of how you apply buy and build with this sort of entrepreneurial model.
It sounds very intensive. How do you folks think about the overall portfolio construction and how you're managing risk across the portfolio?
Yeah, it is without question intensive. I would say our model, probably the chief drawback of our model is the people intensity of it, very operationally intense. So you're spot on with that observation. I think when it comes to our portfolio, the first thing is that we're focused entirely on delivering against that North Star goal, which is entirely around an MOIC performance target that we hope and expect at the end of the day will be best in the world. Then the second thing is we tend to be agile. We're mostly in software and services, Joe, and we try not to be prescriptive about how much of each. We want to be agile to where the greatest return opportunities are at that point in time. And so we're one team, one economic pod without a predetermined allocation of capital or resources one way or the other, so we can be solely focused on the performance. I'd say the third principle around portfolio for us is be diversified enough, but not over diversified. I think if you had 4 companies in the fund, you'd be too concentrated. If you had 44, it'd be too diversified, and it's just too much activity and sideways motion. So I think we put together what's called a fund map. And one of the unique parts of our model is prospectively, even in the fundraise, we're typically able to sketch out a rough skeleton of what we think that fund is going to look like. And in many cases, we already know the industries and the CEOs, because again, we put those things so far upstream that not only is the model that we prefer, but I think our investors see that as like a risk reducer as we enter a new fund. The point is agility. The point is the right level of diversification, not too much. And it's a mix of these buy and builds, Joe, and also regular, larger platform type businesses.
Tell us a little bit more about the CEO training program. How did it initially come about? It's a risky proposition, I'm sure, at the beginning to put this much time and effort into something when you could just go out and hire a CEO.
Yeah. Earlier, Joe, you and I were talking about books, and there's a book that's now, gosh, maybe 10 or 15 years old, but it was written by Chip and Dan Heath. It was called Switch. In the book Switch, the central thesis of that book was this idea of bright spots. So when your child brings home a report card and they've got, a C here and a D minus in science, most parents' inclination would be, hey, what's going on with this D? That's not acceptable. But when you look at that report card and you see an A plus in English Lit, the bright spot thinking in this book Switch is what's going on there that we can do more of. And the answer to your question on the CEO in training was entirely based on that bright spot thinking. So we had this CEO in residence model. I mentioned I was a little bit patient zero of that back in the day. That was working quite well. When we backed CEOs in advance that we really knew and trusted that resembled these attributes I described, we won. And so we asked ourselves a simple question, which was, that's great that we're winning with the CEO in residence model. What is the more button, if you will? How do we build on that bright spot? What more could we do? And that's when the idea of a farm system, this comes all the way back to baseball, Joe, when the idea of a farm system for future CEOs struck us. What if we could build there's a residency for doctors. There's no pathway for CEOs. If you take the best and brightest from the top business schools who aspire to positions of leadership, we've learned so much as business builders about the hard and soft skills of how to do that. What if we build a program, which became the CEO and training program, where we would hire these people, a cohort of say 15 a year, the very best and brightest, and we'd bring them into residence at Alpine. We would match them immediately with one of our portfolio companies where they're an understudy. They're taking on a real job working for one of these CEOs in residence, and then put them in parallel in a 2-year longitudinal training program, which we built. And in parallel, put them into a YPO-like community to be in small pods where they're learning from each other along the way, and ultimately create kind of this insourced recurring model for talent. And that maybe someday the graduates from those programs over time would become our future CEOs in residence who would be running our large platform businesses. You fast forward to today, and that's precisely what has happened. It takes an enormous amount of effort to curate and this community to find and hire these people and develop them and all the curriculum and all that. But for people who are geeks on business building like us, it is in many ways the magic of how we deliver, I think, our exceptional results. So as I mentioned, we've become the most applied to business school job at those top business schools, more than Goldman or Google or McKinsey. And I think we found a market need and met that need. And it's been probably one of our most important ideas.
Why aren't the business schools themselves doing things like this?
They're endeavoring to, aren't they? But as you would know, it's such an apprenticeship field. We all talk quite a bit around how investing is such an apprenticeship business, which it most certainly is. But as someone who has come through the ranks of leadership and being CEO of a few companies, it is something you learn by doing. And I think the business schools are beginning to now evolve in ways that are creating more of a practitioner rubric to prepare leaders, because I think you could historically, years ago, criticize business schools of teaching you everything except the two things you need to know, which is how to hire and how to sell. But it's really an extension of those business schools. So these are remarkable people that have the basics. How do we take them to be world-class CEOs?
So I have to ask the Trading Places question. Can anyone learn to be a CEO?
Yeah, what a good question that is. No, I don't know that they can. But anyone with those core attributes in abundance, I think can. I think Jim Collins is famous for describing level 5 leaders as having the paradoxical combination of a white hot will to win and yet a profound, deep personal humility. And if I had only one sentence shortcut and I could only learn one thing about the person, and it would be that. Do they possess that paradoxical combination? So I think if you have those elements around grit and emotional intelligence, and obviously IQ and clock speed is a part of that, I think you have the building blocks to be a leader. But if you don't have those things in abundance, I don't know. I don't think that's going to work. So at least that's been our experience at Alpine, and the data has been highly correlated to those things. And it's been fascinating to constantly iterate on our rubric for finding people who are likely to be successful, because a lot of people want to lead, but who are those people who have the greatest chance of actually being successful, having followership, having the hard skills, being able to make the tough decisions, and yet being humble and coachable enough along the way to learn from other people's mistakes.
Do you have companies that come to you looking for CEOs?
Last year, we did 172 deals, Joe. 166 of them were add-ons. So it's a remarkable amount of deal volume. And we really pre-select from the top of our funnel businesses for which this talent asset is a massive advantage. So that's why we're frequently in a proprietary deal posture, because you have to have all this to be addressable to that world. When I say this, all of the talent capabilities that we have. So by and large, the answer is yes. If you think about the acquisitions that we do, the partnerships we do, that's a huge draw for the sellers. It's not a hostile thing in any way. I would say Alpine is the antithesis of hostile. But if you're a founder and you've built a business, we liberate the founder to be able to go to the board or go back to doing what they first loved. Maybe it's being the business development person or the customer facing person, and then we'll bring in someone who can take on the day-to-day run the business kind of responsibilities. And we've learned that founders love that. Our founder net promoter score is outrageously high. We measure it quite religiously. I think it's 89 in our most recent survey. And I think that has a lot to do with the fact that they really love this people first model, and they love the infusion of talent juice that we can bring to their businesses.
So you have the CEO and a CFO program. You've got a company that supports SaaS businesses. Is there a larger vision here? How do you see the big picture of Alpine?
Yeah, I would say that we have this idea that in private equity, you need to, really in any endeavor, you have to be able to answer the question of where will you choose to be best in the world? And I think private equity in particular over the years has suffered from a commoditization of everyone sounds the same. And that's probably a disservice to those firms, but it's true if you're an outsider looking at private equity, it all looks the same. And so at Alpine, we have two things where I think we planted the flag, where we are laying a claim to being best in the world. And then a third one, which we're working on. The two, and this answers, I think, your question of what really is Alpine about. I think the two things where we planted the flag are talent and add-ons. And the third that we're working to establish the best in the world status is organic growth. And talent, we've talked a lot about. It's at the core of who we are. The reason add-ons is such a big emphasis for us, I mentioned the 172 deals we did last year. There's two reasons the add-on piece is so important to us. The first is that it really, in a way, Joe, multiplies our talent advantage. So our talent formula applies not just to the platform investments, but to each and every add-on we do, which we view as an opportunity to inject world-class growth talent. And then second, the thing that we love so much about add-ons is it's a terrific way to reduce risk by investing the bulk of your capital once you know that you've got the market, the leader, and the playbook right. It's the power of ex post capital concentration, if you will. So the moral of the story at Alpine is pick a strategy where you make the most important thing be that which you are really good at, as opposed to the opposite, where it's, hey, I'm going to go play the same game everyone else is playing and try to be a little bit better. And what if you could change the game, move the goalposts to a thing that you could uniquely claim and develop as where you are trying to be best in the world? So those two things define Alpine. And then organic growth is that third leg of the stool, which we've been spending a lot of time working on, which we have bright spots on, but systematically we're not there yet.
And how do you folks think about exits?
We tend to be longer hold, Joe, and our investors are aware of that because you do so much work in our model up front with industries and the team that the last thing you want to do is flip the business in 4 years and start all over again. So I think the first thing I would say about exits is we tend to be longer hold. The second thing is that we generally avoid market timing. It's not something that we think is, as an investment committee, we'll talk about some of those things. So you're not ignoring them, but we try not to really prioritize market timing. It's more about building an important, enduring company that has compounding revenue and EBITDA growth. And we're very confident that we'll find the right opportunity to exit that business if we build it right. I would say have in the past had really two types of exits. One is selling in a private sale, maybe half to strategic buyers, Joe, and half to private equity buyers. And then we've also done a few continuation vehicles, done 3 of those where you have trophy assets you want to keep going, but the company maybe becomes disproportionately sized to the fund, and we want to give LPs a chance to get liquid if they wish. Going forward, those 2 things will continue, but I think also some of our businesses are just getting so big that they're probably headed to the public markets. And if you have a business that's 400 or 500 million in EBITDA, it's hard. It's a big equity check. You've got a pretty small number of private equity firms that have the capital to metabolize that. So we'll be looking at public offerings going forward as well. I would love, if I could add one comment, I would love for there to be more innovation in the private markets, for there to be another alternative, which I suppose may evolve, where you could have a private IPO, if you will, where there's a bit of a redemption mechanism and a more liquid in and out pricing mechanism. Those really don't exist today, but I think that as this private market grows and you see the IPO market not growing, there's going to need to be some innovation around another form factor for exiting.
There's a lot of talk about the democratization of alts, and a lot of that is private equity. And even if a small percentage of the private wealth market from retail, high net worth, ultra high net worth came into the market, we're talking trillions of dollars. How would that change the landscape, and would it change the landscape?
I agree. I look at the comment I made and the comment you made, and I put those 2 things together. And I think if you look at what Blackstone and others are doing around trying to give alternative access to the trillions of dollars in private wealth, I think that's inevitable. And then when that happens, I think it's also likely to be true that there'll need to be this sort of this more liquid private animal evolve as well. And it's years away. We're certainly not at Alpine spending a lot of time focusing on that, but just as an interested party, you and I looking at the market, I think that's where this is headed.
So you've been working with technology throughout your career. Where does your thinking start with AI?
It's been interesting with AI. We've invested a fair amount in endeavoring to answer that question. We do have a point of view that while it's exciting to look at what's going on with these language models and everything that's happening in the venture-backed realm of AI, for good reason, it's very fascinating and fast moving. I think the main impact of AI is going to be in everyday Main Street industries. And by the way, those are the kind of industries that we as Alpine are invested in. The application will be different in different ways, but our view is that you have to have an AI component to your strategy, and it needs to have an offensive pillar and it needs to have a defensive pillar. So last year we put that to all of our CEOs and our board leads. We don't have the magic answer there, but we, like many others, are convinced that the impact around providing better service, providing lower cost delivery, providing innovation, or maybe even TAM expansion because of what you're able to do with AI is very real. And we do not necessarily have a dystopian view of that as much as we have a view that it's, name your industry, it's almost inevitable that there will be some form of AI impact. So we have put together a team of people. We're working with our companies. We're identifying those sort of most obvious use cases. And a number of our companies have moved now into the middle innings of that, where we're starting to see some results. I don't think we've yet seen like massive transformational kind of results just yet, but we're committed to that journey. And we see it really in every industry that we're in.
Do you think it'll provide efficiencies, especially in the SaaS businesses?
In SaaS, the most obvious use case is in developer efficiency, and it already has. You can typically deliver 20 to maybe 30% developer efficiency using AI just on the code side. And so ASG in particular is one of our portfolio companies that's focused on vertical SaaS, has a group of 3 or 4 people who are focused on implementing that in each of the different verticals that we're in. So I do think it will impact there. I don't know that it stops there, but that's really been the most obvious focus area for us in phase 1 of figuring out AI in SaaS.
Mark Strauch, thank you for joining us, and thank you for your excellent insights.
Insights they are, excellent or not, I won't be the judge, but Joe, I really enjoyed it. Thanks for having me.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.